There are a whole lot of cross currents happening right now in the economy that have important ramifications for monetary policy. The problem is that nobody knows quite what those ramifications are.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
The Fed decided, as widely expected, to keep their benchmark interest rate targeted in a range between 3.5 and 3.75%, expecting one rate cut this year, one rate cut next year, and then the Fed funds rate settles in around that long-term neutral level of 3.1%. Being able to forecast, it's not easy. It's going to be something that I think you'll see a lot of debate in future FOMC meetings. The Fed likes to call itself data dependent. It sounds great, but one of the criticisms that it faces is that it's always looking in the rearview mirror. Inflation has proven more stubborn than the Fed had anticipated. On top of that, you have tariffs. That just has caused a general drift higher in inflation expectations. The Producer Price Index measures wholesale prices. That was higher than expected for February, and that tells you that there are inflationary pressures within the pipeline that could cause issues for later on. On top of it, the labor market is in a large state of uncertainty. The Fed still expects the unemployment rate to be 4.4% at the end of the year. That's right where it is now. And the curious thing about that is we've seen basically no hiring. Changes in demographics, changes in the size of the labor force, and of course, changes in our approach to immigration in this country. It has limited the labor pool, and it has actually limited the extent to which companies can add workers. Policymakers like Jay Powell are getting accustomed to this. He seemed almost okay with the idea that we're in this flat job growth climate as long as layoffs don't start. Fed's ability to influence broader market rates right now is pretty limited because of the unique set of circumstances that we're under with the economy now. Of course, as long as the Fed holds steady with its Fed funds rate, we're probably not going to see any relief for consumers.
This is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know.
What the chair talked about with the Summary of Economic Projections, or the SEP as we call it, she just talked about the difficulty in being able to look out and try to come up with reliable forecasts. The Fed actually raised its GDP growth levels, looking at 2.4% this year, 2.3% next year, and next year's growth rate was marked up by 0.3 of a percentage point. The only thing that Powell commented about the future is he said he's not going anywhere as long as this investigation continues into the Fed's renovation project. Independently of that, he also is going to stick around until Kevin Warsh can be confirmed as his successor. Those two things work hand in hand. He did not say what he will do in terms of staying on the Board of Governors as a governor. And it certainly fits into President Trump's calculus about how he wants to reshape the Fed Board.